Welcome to The Explainer. Today, we are diving into a huge topic for so many of us in Australia, trying to get a foot on that property ladder. We're going to break down a really innovative strategy that could honestly change the game for you, your friends, or even your family. So let's explore how you might be able to co-invest your way into a home without falling for some of the really common traps. It's a question on a lot of our minds, right? You look at the house prices, you look at your bank account, and the whole thing can just feel completely impossible. That feeling of being priced out of the market, it's very real, and it's exactly what we're tackling today. And really, this is the heart of the problem. Even if interest rates come down a bit, the sheer size of the deposit you need and the loan you have to get, well, it makes buying a property by yourself a massive, massive challenge. For a lot of people, the numbers just don't add up when you're going it alone. So the most natural response is to think, hey, let's team up. But here's the thing that most people don't realize. The old school way of getting a joint loan is like walking through a minefield. It's filled with hidden risks that can seriously mess up your finances for years to come. Okay, let's zoom in on the biggest trap here. It's this technical sounding thing called joint and several liability. What does it mean? Well, it's terrifyingly simple. It does not mean you're responsible for your half of the loan. No. It means you are 100% responsible for the entire loan if your co-borrower can't pay. On top of that, any bank sees you as holding that entire debt, which can absolutely crush your ability to get other loans down the track. And if one person gets into financial trouble, it can wreck everyone's credit score. It is just a messy, high-stakes way to do things. But what if you could get all the benefits of teaming up without those huge risks? What if there was a way that was specifically designed to avoid every single one of those traps? Well, that's the whole idea behind this property share model, and it is a total game changer. The concept itself is actually pretty simple. You and your partners pool your money to buy a property, but, and this is the key, you do not share the debt. Everyone gets their own separate loan, which is tied only to their share of the property. This one single difference is what makes the whole thing work so beautifully. And this table just lays it out perfectly. Look at the difference here. In the old way, you're liable for absolutely everything. With property share, you're only on the hook for your own loan. Your future borrowing power isn't weighed down by the massive total debt. It's protected. And getting out of the deal isn't some horrible legal nightmare. It's all planned out from the start. You're getting the power of the team without getting financially tangled up with each other. So what does this actually mean for you? Well, first off, you've got way more buying power to get a better property, maybe in a neighborhood you thought was out of reach. You're spreading out the financial risk instead of shouldering it all yourself. For anyone trying to buy their first home, it's just a fantastic way to get past that first huge hurdle. And it can even be an amazing tool for families to build wealth together across generations. Okay, this all sounds great in theory, but how does it actually work in the real world? Let's get into the nuts and bolts of how these deals are put together. Now, a structure this powerful needs some important rules to make it work. First, everyone involved has to be on the property's title, with their exact ownership shares spelled out. And while your loans are separate, you do provide security guarantees for each other. Basically, that means if someone defaults, the property itself is the security for all the loans. And here's a really critical point. Not every bank offers these products. You have to find a specialist lender who actually understands and approves of this kind of setup. And here's a number you really need to remember. Lenders want to see that everyone is seriously committed. This isn't about one person having a 98% share and two others having 1% each. Nope. Typically, every single partner needs to own at least a 20 to 30% stake. This makes sure that everyone has significant skin in the game. All right, let's make this really concrete with a couple of quick scenarios. First up, a super common one, a group of young professionals trying to break into the housing market. The situation is a classic, right? On their own, none of them can really afford the type of place they want to live in a location they actually like. The solution? They pool their deposits together. Each gets approved for their own separate loan, and suddenly they can buy a much higher value home together. They get onto the property ladder way faster, and their individual finances stay protected. Okay, now for another really powerful scenario. This time, let's look at a family strategy designed to help the next generation get a head start. This is just so clever. So, parents can use some of the equity they have in their own home to help with the deposit. They might take, say, a 20% ownership share, and this is the absolute key. They do it without taking on any new debt themselves, which is huge when you're near retirement. Then their kids go and apply for their own separate loans to cover the other 80%. It's just a brilliant way for parents to give a helping hand without taking on new financial risks. Now, as amazing as this strategy can be, it is absolutely not something you just jump into without thinking. Its success completely depends on setting it up the right way, right from day one. Okay, if you remember one thing from this entire explainer, please let it be this. You must have a detailed, rock-solid co-ownership agreement drawn up by a lawyer. This is completely non-negotiable. This is the document that protects your friendships, your family relationships, and your money when life happens. It needs to spell out everything: who pays for what, how decisions get made, and maybe most importantly, a crystal clear exit strategy. What happens if someone wants or needs to sell their share in 5 years? You have to have the answer to that written down before you buy the property. And this all just highlights a key piece of advice that came from our source material. This is not a DIY project. To pull this off correctly, you need a team of experts. You need a mortgage broker who specializes in these loans, a lawyer to draft that crucial agreement, and probably a financial planner to make sure it all aligns with everyone's long-term goals. So, to wrap it all up, this property share co-investing model can be a seriously powerful tool. It can open doors and create opportunities that are just totally out of reach for most of us on our own. But, and it's a big but, it is a sophisticated financial move that demands careful, thorough planning and professional advice to get it right. And that leaves us with one last question for you to think about. In a property market that feels more and more impossible, maybe the solution isn't just about trying to save more money, but about trying to think differently. Could a well-planned, well-structured partnership be the key that finally unlocks the door to your own property goals?